And yes, Bitcoin's market cap today is 1.3 trillion, but 1.3 trillion didn't go in. It was a very small fraction of that, somewhere in the 200 something billion dollars. And the rest is appreciation, because every time money goes in, it's, to your point, 7,300 Bitcoin demanded and only 900 produced. Well, where's the other Bitcoin come from?
Hey guys, welcome back to Everyday Finance. In today's video, Mark Yusko shares his insights on the adoption curve of cryptocurrency and its potential for growth. Understanding the significance of establishing a network of reliable sources and staying updated on the latest tools and technologies is crucial for billions of users, and lots of things Mark Yusko discusses, so please watch the video to end, and share this video, and subscribe our channel, Everyday Finance. Thanks.
Yeah, well, look, I actually never felt that the ETF was for the big institutions, right? It doesn't mean that they wouldn't use it, but ETF
it's a retail, it's a retail product.
Yeah, it's for the individual investor. And really what it was for was not the Robinhood crowd and not the meme coin traders and the day traders. It was for, again, it's a boomer wrapper. It's for the boomers whose money has been kind of abdicated to a financial advisor. And the financial advisor works at one of these big platforms, UBS, Merrill Lynch, etc. And that total dollars is about 30 odd trillion. It's a lot. And I kept saying that, look, once the ETF was approved, at a bare minimum, right away, 10 basis points was going in. So that's, about $30 billion. And we've had about half of that so far. It's pretty good in whatever it's been, 10, 12 weeks. And so that's pretty amazing. Now, 10 basis points is not where it's going to stay, because Fidelity already said 1 to 3% in their kind of fund of funds ETF that allocates to other ETFs. They said 1 to 3. And I think all these other places are going to say, 1%, that's a good number. That's a good diversifier. Well, 1% of 30 trillion is 300 billion. That's more money than has ever gone into Bitcoin since day one.
Yep.
Just let that sink in for a second. 300 billion is more fiat than has ever been converted into Bitcoin. And yes, Bitcoin's market cap today is 1.3 trillion, but 1.3 trillion didn't go in. It was a very small fraction of that, somewhere in the 200 something billion dollars. And the rest is appreciation, because every time money goes in, it's, to your point, 7,300 Bitcoin demanded and only 900 produced. Well, where's the other Bitcoin come from?
That's a big
Holders.
shift on the.
And the only way a holder sells is if the price moves.
That's right.
That's how markets work, right? Everybody's always, I love when people say, there's more buyers than sellers.
Same
No,
amount.
there's not. It's the same amount. There's always the same number of buyers and sellers. Now, the incremental dollar can come from buyers or sellers, but that incremental, like if you're a short seller and you're trying to, sell something that's overpriced, then in order for you to buy it back, you want the price to fall, right? That's right. What you're expecting. If you're long, you're long an asset and someone wants to buy it from you, the only way they're going to get it is if they offer you more than you think it's worth. And so that incremental pressure, but once the transaction occurs, the number of buyers and sellers are exactly the same.
Bitcoin remained steady at around $69,500 on April 10th, just 2 days after coming close to its all-time high of $73,500. With less than 10 days remaining before the Bitcoin halving event, there is speculation about whether the previous all-time high price support level will hold. This recent development marks Bitcoin's third unsuccessful attempt to surpass its all-time high, indicating traders' uncertainty at these record levels. Profit-taking or increased selling pressure is hindering further upward movement. The repeated rejections of Bitcoin's upward movement raise concerns about the possibility of significant price drops in the upcoming weeks. Arthur Hayes, one of the co-founders of BitMEX, has made a prediction regarding the upcoming Bitcoin halving in April. He believes that this event, combined with the strategies being implemented by the US Federal Reserve and the Treasury Department, will lead to a significant sell-off of cryptocurrency assets. According to Hayes, there are potential risks for volatile assets in the latter half of April. During this time, there was a decline in liquidity as a result of US tax payments, the start of quantitative tightening by the Fed, and the upcoming use of the Treasury's general account. According to the analysis, there is a potentially unstable period for high-risk investments from April 15th to May 1st. This is due to tax payments draining liquidity from the system, while the current elevated pace of quantitative tightening continues. Additionally, Yellen has not yet begun reducing the total job assets. However, after May 1st, the pace of quantitative tightening decreases and Yellen becomes more active in boosting asset prices. Let's back to the Mark Yusko interview.
28 years into being a public company, still has very high volatility. Every single year, right, including this year, it's had a double-digit drawdown. And that happens. Right? Every single year, on average, you lose 31% of your money in Amazon, but the stock just keeps going up over the long term. So the volatility is going to be here. Now, the question of, is it going to stay 80, which is coincidentally the number that Amazon volatility is, or is it going to slowly trend down as more money comes in? That's just the law of large numbers, right? If I have a small dollar value, like I have $100 and I put in another couple $100, the volatility is going to get really high. If I have $1 million and I add a few $100, there's no volatility at all. So as increasing volumes come in, but the market cap gets bigger, the volatility will shrink. But it's never going to be a stable coin, I don't believe, because volatility is an indication of uncertainty or disagreement about the future. So if you think about a bond, right? We all know a bond is a contractual claim. And if you lend to somebody who's creditworthy, they have to pay you back. So there's not a lot of volatility in bonds. Now, if interest rates rise a lot, there could be short-term volatility. But at the end of the day, you hold a treasury bond to maturity, the government's going to pay you. They'll just print money to pay you. So the volatility of bonds is very low because the uncertainty is low. In equities, there's more volatility because we don't know. Right? When Amazon started, people thought, that's a dumb idea. I don't want to buy stuff on the internet. I don't want to put my credit card on the internet. Today, you do it without even thinking about it. Same thing with Bitcoin. In the early days, you'd be like, I don't want that. Today, I get it. It's a perfect store of value. It's a better form of money. And over time, that uncertainty about the outcome will diminish. And so the question is, are the days of 80% drawdowns over? Well, the first cycle drawdown was 84. Second was 84. This last one was 77. I think this next one likely is a little bit less. Why? Well, because I think the upside of this cycle will be less too. If you go back to each of the previous halving cycles, we had these big run-ups. Went to 2.3, 2.4 times the fair value. Well, why would anything trade above fair value? Well, humans are going to human. Humans, mostly they can't do math, to our conversation earlier. But then secondly, they FOMO, right? They see something moving and they got to get in. So the price goes up above fair value. Right. But then what happens is leverage comes in and the gamblers and the speculators come in and that pushes the price way above fair value. But at some point, gravity takes over and you head back toward fair value, and you usually crash right through. And then you get to a washed out, really undervalued, because you got margin calls and you got the unraveling.
A recent survey conducted by Deutsche Bank highlights the contrasting opinions among consumers regarding the future of Bitcoin. Approximately 1/3 of respondents predict a significant drop in value, with expectations of it falling below $20,000 by the end of 2024. This projection is a stark contrast to its current price of around $50,000, resembling the lows experienced in 2022. Only 10% of the 3,600 participants are projected to surpass $75,000 by December. On the other hand, 40% hold an optimistic view of Bitcoin's long-term prospects, while an almost equal proportion of 38% predict its eventual disappearance. According to market analyst WCK Capital, Bitcoin is projected to experience a significant drop to approximately $40,000. This prediction is based on the observation that Bitcoin's price movements have followed similar patterns to the previous 3 housing events. The chart below shows the price trends around housing in 2020 and 2024, highlighting their similarities. The highlighted area in blue on the chart is of particular importance. It corresponds to the region where Bitcoin has historically undergone retracements of approximately 20 to 40% before significant events, such as the one in 2024. Prior to the 2020 halving, Bitcoin's price experienced a pullback of around 18%, which is close to the expected 20% correction. This suggests that there may be further room for decline leading up to the upcoming halving, which is less than 10 days away. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.